The EPS, or earnings per share. This number is one of the most important numbers a person can understand. Let me explain. Let's say we have a coffee shop on Main Street and someone is trying to sell their store for $500,000. Let's also say that this same coffee shop sells about $250,000 worth of coffee every year. This $250,000 is often called the sales or revenue. This is also referred to as the top line. It's called the top line because no expenses have been subtracted from the money collected from the customers. Now, when we account for employees, rents, loans, electricity, and even taxes, there's a very, very important number that's left. That's the profit. Now, finance geeks like to call this the net income, but what you really got is the profit. This number is important because it gives the potential buyer an idea of what the business might be worth. So let's say from that top line of $250,000, there's $50,000 of profit left in the business after all those expenses and taxes are paid. Let's also say that the company is broken down into 100,000 shares. That's just a fancy way of saying it's divided up into 100,000 pieces. Once that division occurs, that means the seller wants to get $5 a share for every 50 cents of profit the business produces annually. So when you see the term EPS, you need to think profit per share. In this scenario, if you were going to buy just one share of the business for $5, you might expect to get a 10% annual return if the profits remain constant at 50 cents a share. That's why you always need to compare the profit with the market price. It gives you a fast and easy way to estimate an expected return.